The last but not least, the double declining balance method. And so this gives the concept that some assets lose value significantly more quickly over time than other assets. And so a good example might be computers. And so even if we have a 5-year useful life on a computer, like we might use laptops. I'm using my company's laptop, and it was brand new when I received it 3 years ago, and now it went from $2,000 in value to now you can buy it for $500. Laptops generally depreciate extremely quickly in value, right? A lot of computer and technological equipment depreciates quickly. So a company may adopt for its technological equipment the double declining balance method, where you determine the rate to be twice as much as a straight line rate at any given time. This is probably the most complex method. It was on my CPA exam. So the sooner you learn it, the better. You'll be tested on it multiple times through the rest of your accounting equation. One of the reasons this also exists is because it increases your expense in earlier periods. So some small companies who aren't interested in presenting strong financial statements but are more interested in tax deductions may prefer this method, so they take more expense up front. But tax laws are slightly different now, so take that with a caveat. But there might be reasons why companies want to present more expense up front. That's the main reason. Another main reason they might take the double declining method. So let's use the same fact pattern, exact same fact pattern, right? We know all this information. How will we determine it? Well, we know the straight line is 100% divided by the useful life. So we know the straight line is 100% divided by 5 years is 20% a year. For those of you that don't remember, we're on slide 36. We calculated that all the way up here, 20%. Then we just multiply that percentage by 2. So we're going to take twice the amount of depreciation per year, based on a percentage, not an amount. So the depreciation expense is going to be, for the first year, is going to be 40% times the 10,000, which is 4,000 for the first year. It's important to caveat here, this does not use salvage value in the calculate or the original calculation. So for a straight line, we're doing the 20% times 9,000. Double declining is the 40% times the full book, or the full value, full book value. So that's another difference. So that's 4,000 for the first year. Well, the original straight line was the 20% of the 9,000, the 1,800. So 10,000. The depreciation expense for year 2 also gets more complex. So then we're always going to be taking the double declining rate, that's 40%. That never changes. That's always going to be the same for the rest of the problems for the double declining method. However, that 40% is going to be multiplied by a moving variable, which is going to be the book value. And so that 40% the next year will be 40% times the 10,000 minus the 4,000 lost. So 2,400 the next year. So we're always decreasing this is an exponential decrease method where we're doubling the value and then decreasing it at an exponential rate. So 40% times the 10,000, this is the total book value minus the 4,000 of the depreciation up to date to equal the 2,400. And this is our depreciation expense for year 2. So you can see this method, that's how this calculation is formatted. 10,000 times the 40%, we know how we calculate the 40%, that's just 2 times the rate that we had in the straight line method. Always have to calculate the straight line method's rate first, then multiply it by 2. Then we multiply this to get our depreciation expense. The difference here between the straight line and the double declining is the double declining uses the salvage, doesn't use the salvage value, while the straight line uses the salvage value in its multiplication. Then this is our end of period accumulated amortization and our net end book value. Then we're going to take the net end book value and multiply it by the 40%, which is where we get the 2,400. And we continue so on and so forth to continue to calculate the net book value and then multiply it by the 40% until we get to the end. Now what's complex here is in the last year of life, we can never have more depreciation expense than our salvage value. And since the double declining method isn't even, sometimes we will have more depreciation expense. So it's always limited at the salvage value. So at this point, we only have 8,704 left on the asset. So then the end of accumulated depreciation, the end value of the asset on here is 1,296 on year 4. Sorry, 1, 2, 3, 4, year 4. Based on our calculations. We know that the salvage value is 1,000. So even though if we recalculate this, 1,296 times 400, right? 1,296 times 0.4, we get 518. But we can't recognize that because that's higher than our salvage value. So we're going to cap it at 296. So we true it down to our salvage value. So this is another trick question that could be asked, right? You're going to have to know exactly what's included in the straight line method, the double declining method, and the units of production method. Straight line excludes your salvage value from the original calculation. Double declining includes it, right? And then at the end, we have to always calculate every single year in order to determine the last balance here.